Welcome to the Dividend Talk Podcast, episode 278. Building wealth together with our community portfolio review. European DJI, it's week one of 2026. What a crazy start to the year.
My God, I was working, but then sometimes sneaking into what's happening in the stock market. My God, it was crazy, really crazy. Like, have you seen this? I looked into my portfolio and it was really going up. And I've got a very value-oriented portfolio. So to see Novo Nordisk and these companies bounce up so much this week has been crazy. So it really lifted up my portfolio a lot with what's happening. And then we'll talk a bit later about all the news coming out of America, Venezuela, everything. Like probably 10 years ago when I started investing, if you had this in a quarter, you would say busy quarter. We get it in 1 week. It's crazy. It's crazy. And this is not to blame the media. This is just real stuff happening. Yeah. For good, for bad sometimes, but generally it all impacts our portfolio to some extent. But I think mostly what I've been experiencing is what I think has happened, what I've seen now already several years, is that some stocks really get hammered down in December still because of tax harvesting. And you have this wash sale rule in the US that you can't buy back for 30 days. And then now at the 1st of January, some of them really pop up. And I think Novo Nordisk is a really good example of that. Not too long trading at around $50 if you take the US ADR, and now almost $60. Of course, there's a lot happening there as well. We'll discuss a little bit news of the week. So it comes a bit together, but some of the news was already out there before, right? So I really feel like they're buying back some of those value stocks right now to have them in their portfolios, because simply said, if you're a fund manager at the end of the year, you don't want some beaten down stocks necessarily in your end list of what was part of the composition. I think it's in the end as simple as that.
Yeah. It could be. It could be as simple as that. Maybe there's a broader picture. There's a lot of talk of the market being hot at the moment. A lot of people are comparing these forward PE ratios of the S&P 500 and historically what happens when it reaches 23 and so on. So who knows? Macro investing is probably not our strongest point. We will admit that. There's a lot of things at play, but it's quite fascinating to watch. And Donald Trump likes to start the new year with a bang, I have to say. He just keeps us entertained. You posted some stuff on our social network about just some of the stuff he's done in the last week. It's madness. But first of all, what are your thoughts about that? But more importantly, not political. What are your thoughts a little bit about that in terms of our portfolio exposure to the US? Because we both have quite a healthy exposure to the US.
Yeah, exactly. Because this is not a political podcast, right? And I don't really even care about that stuff so much anyway. But no, I think this must be one of the most productive administrations that I've ever seen. Just an example, Maduro got captured, whatever you think about it. They then also captured a Russian flagged ship, oil tanker. So puts pressure there. JFK Jr. with a new food policy, which impacts Pepsi and the likes. Then they are announcing restrictions on institutional home ownership. You can think about Blackstone here. A lot of these policies impact the stock market directly, right? So it's really never a dull moment with this. Then they're also pulling out of all those agreements with the United Nations as such. Oh, they want to take over Greenland as well. We even forgot about that one. Yeah. So in a single week, we're talking here about. And this is all hitting our portfolios, right? To some extent. Maybe not directly or indirectly, but I own some Chevron, ExxonMobil. I've not seen this kind of volatility in a very long time in these stocks. Going up, coming down again. And yeah, this is just crazy. It's just crazy. And I think we need to do a show about this one time, because the main question I would like to discuss one time, not just with you, but maybe with a macro expert. So if someone has a good recommendation, let us know. I would like to discuss one time, okay, what if this, to Ray Dalio, is indeed the end of an empire and a changing world order? What can we do as European-based investors with our portfolio? Should we buy more European dividend stocks? it's not an easy question because there's so much international exposure in the companies we hold. There's so much currency fluctuations. Look at our portfolios from last year. They got smashed because of the dollar currency. Yeah. And I will release my annual report next week. And it's very clear. Like if I look currency neutral, quite okay. If I take the currency into account, it looks bad. Yeah. And we'll later talk about Fundsmith as well as one of the listed questions, the same. So, then you have hedging strategy, everything. It's quite a complex topic, but the time, I have a feeling that time is a little bit coming to an end that you could just blindly invest across Europe and US without needing to think too much. I think we are now entering a period where you need to be a little bit more having some strategic foresight. Yeah, and that's not an easy topic. So I would love to do a show about that one time. Not going into the politics, but just accepting that the geopolitical landscape is changing.
Exactly. And I know we mentioned on the show quite a few times, even when we had Leo on the show, that we tend not to look at the macro environment, that over the long term, it will play out, but it's just so volatile at the moment in the US.
Exactly.
There's this thought, Ray Dalio has the book on the end of an empire. So it would be a little bit foolish as European investors because we have an advantage where we're not home biased in terms of the US. I know the US has historically better dividend growth profile than European companies, but we have options and advantages as European investors. So we should look at it
exactly from that angle.
Yeah. And see, that's a nice topic. But hey, you mentioned your annual report. Looking forward to that. Are you reporting on a constant currency basis? You like Nestle or?
I do both. I do both always because I need to, and it's important for me to know the underlying strength.
Yeah, so of course, I tease. Look, as always, look forward to that.
But I'm not masking it. Yeah, that's the difference. I'm not masking it. I'm not the one saying like, yeah, this and this and this on a currency neutral basis in the brackets and then hide the real performance in the bottom somewhere on the 6th page. And then when you have a good year, when you benefit from it, you don't mention it and you claim all victory.
No. So like, I'm just guessing that in your highlights, you're going to have adjusted dividend growth.
That would be a funny one, yeah. No, but you know what the benefit is of this? The only one I need to be honest to is myself and my family. I need to look in the mirror. While I respect our community a lot, I'm not investing for my community. The only one I'm accountable to is myself. So what every investor should remember, don't fool yourself.
Exactly.
Don't fool yourself.
Say what you want in public, but if you're writing it privately, be open, be honest.
Yeah, exactly. And don't be ashamed when you have a good, bad year. Don't be overly excited when you have a good year. Just remember that a lot of things you don't have in control, but over the long term, your strategy gives you this control.
Exactly. And look, it's proven. We have plenty of examples of people within our community that have proven that.
Exactly.
Moving on to Novo Nordisk. I mentioned at the end of last year that it was the most mentioned company on this podcast last year, particularly in the news.
Awesome.
So we start the year as we ended last year.
Of course.
As you mean. But what's changed? But again, look, it's in the news, but this time it's in the news because Amazon, their pharmacy department, is starting to offer their weight loss pill.
Yeah.
Which is quite interesting and a big shift away from this dominant business model that they had where drug prices were managed through health insurance plans. So obviously this is going to impact margins and prices. And I'm just curious what your thoughts on this is.
I think new management is finally aggressive, understanding that the first mover's advantage doesn't give you exclusive rights all the time. No, it allows you to be very aggressive and to lead the market for some time. But just know that in this market, there are a few people that are like Pac-Man trying to eat your revenues, right? So I vision this. This is Pac-Man, and yeah, so they need to be fast with this. It's good. It's good to see. Later on, I'll tell you what Terry Smith thinks about it. It's also quite funny. I like this guy. He's too European, too less English, too mainland European. But in any case, look, this is really good. What's happening now, this aggressiveness, offering it everywhere where they can via the popular channels. The main question I have is about the cannibalization of their own revenue stream. What are the margins on these pills? So this can only really work out from a cash flow point of view if they sell, I don't know, 3-4 times more than they would do with an injection. Yeah, because if an injection, I don't know, was $400 or $500 per shot, and now you have a pill for $150, what's the margin? Yeah, so I think this is really the question that I can't answer. I don't know that well enough. Maybe I need to do a bit more research, but the margin, I will really look for that in the first commentary of management about this, because they are going to cannibalize a lot of their own supply, but also Eli Lilly's supply, of course. They have this opportunity from what they did with Ozempic to create the first brand name again, and try to make it kind of Coca-Cola naming. It's a bit hard, of course. You do this over multiple decades. That's their opportunity right now, and they can't screw up. Former management screwed up. This one can't afford it, and I have a feeling that getting into Amazon as such, I hope they didn't sell their soul to Amazon, that Amazon gets to everything in their annual report later as the big boom. But that's the question that's hanging over now. And the market is already running up for it because they probably look at the headlines like this. But I'm more concerned about the cash flow about this. So I'm still on the fence, to be honest.
Yeah. So I mentioned that to you, margins is obviously a big concern. But I'm also wondering, will they have exclusive rights to be selling on Amazon? Or does it open the door for every drug manufacturer to do the same? And if that happens, not only are they cannibalizing their revenue in terms of a lower product, there'll be a price war. And customers, self-paying US patients will go for the cheapest option.
As long as it's only with Eli Lilly, who will come in the second half of this year probably, and Novo Nordisk, I'm not too concerned about a price war. I see it more like the prisoner's dilemma, like what you see with Coca-Cola and Pepsi. If one of them would lower their prices, then the other one has to go down as well, both eroding their profits. So they have a natural incentive to not lower and not go into a price war. They will need to do it via marketing, not via price. Price will be the last resort because both will go down and it will become a very thin margin business then. So I'm not so too concerned yet for 2026, but obviously, already 150 a month from 400 or 500 a month is very aggressively priced, right? Like this. So, but I'm not. If you understand the concept of prisoner's dilemma, Derek, which then I think when you have an oligopoly with two players in this market, they will not do that because they need to earn their R&D back.
Yeah.
But at this once the generic kicks in, and the generics are not there yet. They're far still from this because the patents are still having lots of exclusivity. The fact that there are multiple players is because those are different patents. Those are different compounds to solve the same thing, to come to the same endpoint. Yeah,
and there's nothing stopping a Chinese company or some other company coming up with a different compound to build the same solution.
So that's true, but it's not like every road leads to Rome. Yeah, there's just a limitation in healthcare and the human body on how to achieve that.
Yeah. No, I 100% get that, but like the point I'd be making is that it's easier for these companies to put the product on Amazon than it would be to sell it through an insurance based where doctors have to prescribe it to you. So you can have competition from China.
Yeah.
A lot more easier than...
Yeah, but there will be a large-scale crackdown in the US on this. The only reason why this was happening now is because Novo Nordisk was not expecting this quick scale-up. So the manufacturing was not ready. Therefore, there was this law in the States that 6 months people can create generics. It's been happening, a little control over it. I don't think that will happen quickly if Eli Lilly is also in the game like that, because then we have US company there as well at risk of their profits. So
yeah,
and I'm not so negative about that one thinking. And also, do you really want pills produced where you don't know how they are manufactured? I mean, it happens, right? People are price sensitive.
Yeah,
that's not good for society, really not.
Like you see, and I know it's different with pills and clothes, but you see that the whole time. Like people know the quality might be a little bit lower coming from China, but the price point is so low that it makes it worth the risk. And look, I personally wouldn't do it, not with my health, but I'm just saying like people in this situation might be desperate and they might not be able to afford 150.
Would you buy a weight loss pill from Temu?
It would be invisible. But look, on the positive side, I think the weight loss pill is a much better product than the injection. I think a lot of more
so as well.
I think a lot more people would be open to that.
And then the market, the total addressable market is, I mean, we're still in the low single digit percent of opportunity, right? If you think about the amount of overweight people in the world, obese people in the world, I mean, this is a growth market for a long time still. Yeah. And it's not a winner takes all market either. So
interesting. I'm kind of interested in Novo Nordisk. I have a couple of puts open. I told you about that last year when they dropped, I think, for $40. They're nowhere near that now. So it looks like I could take most of the profit now and I would be happy. So
I have, the full disclosure, I have a position in Novo Nordisk, both in my own account and a bit in the retirement account. And I also have a call option at $50 in March. Outstanding. I bought it like half a year ago by selling a $45 put option. I used the proceeds to buy this call option so that it comes at zero cost. Or I need to own the company and the shares at $45 by March this year. Or I can cash in. And I don't think I will use it to buy Novo Nordisk shares for the simple reason that it's already kind of at my position. I will buy some, but not 100 because then I would go much over my position sizing. So full disclosure there.
Nice one. We got a couple of questions about Rio Tinto and Glencore. So Connor has asked us, what would you make of the merger between both Rio Tinto and Glencore? I think you still have Rio Tinto in your portfolio.
Yeah.
And Mr. Maxi has asked us something similar as well. There's two parts to their questions, but we'll stick to that one at the moment. Quite interesting. This one seems to rear its head at the moment. If it did happen, I mean, it would be huge. I don't know if competition laws will allow this, but Rio is a top 3 iron ore producer. Glencore is obviously a major copper and coal player that is like dominant in the world. So coming together, they would control a whole lot of commodities, which would give them a lot of pricing power, you would say, and maybe take the cyclicality out of that company. And it would make, from an investment point of view, it would definitely make them a lot more interesting in terms of not that cyclical nature. They might be able to balance that out. I have to be clear that they're only in preliminary talks. Both companies have mentioned this on their website, and Rio Tinto have until the 5th of February, if I'm right, to decide whether to proceed under UK takeover rules. They can ask for an extension, but at the moment it's coming up to the 5th of February. So quite interesting. What are your thoughts on that, first of all, as a Rio Tinto shareholder? What was interesting for me is that Glencore's share price dropped and Rio Tinto's went up based on the news.
I wasn't even aware of it. So that's why it's so good that we do this podcast. So thank you for asking this question. My position is so small that I only look at the stock once a year, Derek. So I wasn't aware of it. I can't say a lot about it. From that point of view, what I would like to say is, like, I'm always concerned that they overpay for these kinds of things, and that the balance sheet looks very poorly. We know that this is typically a commodity cycle. So that's why I appreciate Shell so much and the other oil majors. They try to have an A-graded balance sheet in good times, and they don't leverage up in good times. Yeah, they use that when there are bad times to leverage a little bit up to protect shareholders from dividend cuts and such, right? So this would be my big concern, and I haven't looked into it to be able to say something meaningful about it there. But have you had a chance to look at that, let's say, depth profile potentially here?
Yeah, I mean, so I did mention that Rio Tinto shares dropped, and the reason for that was because of that fear. It would be heavily, obviously, impacting the balance sheet, but also the cost of the acquisition. Many investors believe that they'll be paying well above the odds on that.
Wow.
On top of that, my concern was, I've just did a deep dive on Smurfit Westrock, and if you remember way back, Smurfit Kappa was the original company, Irish company, and I was really positive about them. Really nice company, well managed, progressive dividend and the whole lot. They've become a much larger company after this acquisition with WestRock.
Yeah.
But the integration, it's tricky. I mean, there's a lot of moving parts to it.
Most acquisitions fail to live up to the promises.
Exactly.
And you get bad balance sheets after that.
Yeah. And with one that is so large, you have two really big companies in different industries as well. Trying to tie all them together will be a lot more difficult than I think than that.
I give you an example. I own Paychex, right? Paychex bought Paycor last year.
Yeah.
Full cash leverage via debt, 10 billion or something like that. And they say, we are going to, at least in one part of the announcement, say, we expect 80 million synergies in the first year or something like that. But the interest expense, because of the 10 billion, is 129 million. So what are we talking here about? Yeah. So these are the kinds of things you need to look at, right? If they say, we'll have 500 million of synergies. Okay, good. Show me the interest expense that this costs. That's the first litmus test I often do with acquisitions.
Yeah.
Specifically when they are debt funded.
Exactly. Exactly. And it's a good test to do because synergies is a nice word. It sounds really well, looks well when you write about it, but it's often hard to make those numbers live up to expectation.
But then you see ASR acquiring the Aegon portfolio, and they deliver it very fast. Yeah, straight away, almost cash positive, everything. Those are the acquisitions I like. Yeah.
Yeah.
But here we're talking about many physical assets, difficult supply chains, integrating all of that. Poof.
Yeah. And then you have two different cultures. I mean, you have Rio Tinto and then you have Glencore. Like, one's from Australia. It's a different culture. So you have to try and integrate all that in.
So M&As are really, really tough for that. But if done well, they create massive cash flow opportunities. So we have seen that also in the past. Yeah.
I think if the merger happened, it would not make me an automatic buyer, but it would definitely strike me to put them on my watch list and watch how the acquisition progresses. Because I think then long term, this company would be definitely something to have in your portfolio. But I don't think it'll pass the UK competition laws. I don't. But.
And there was a really nice video on. I don't know who was it, but there was someone talking about like how I think Germany spent more than $1 trillion or something like that on clean energy, but then there was less demand and at a much higher price. Yeah, and for the 5 or 6 years that we have this podcast, I've been always saying like I think we are underestimating the dependency and need for oil and gas. Yeah, it's just playing out in front of us now. So what I'm trying to say with this is like, we may have the desire to live in a very clean climate. The reality is due to the complexity of how the world operates and everything, it seems more a desire than reality. Yeah. So, and I'm here to make money, first of all.
Money talks.
Yeah. Exactly. So I wish to live in a climate because honestly, if I walk outside here in Poland with this weather, it's -10. There's a lot of smog on the street and I'm concerned about that. I don't like that. I don't want here to be brown coal still. I don't want it.
Yeah.
But it's good for my portfolio. Yeah. But even because my portfolio reflects the fact that the people around me need it because they can't afford, very simple. If you live on a minimum wage here, you can't afford installing a whole gas-heated system in your house, insulate all the walls, put new windows in. It costs a fortune. People don't have money for it. What they do have is a brown coal chimney already for 20, 30 years. So they will need brown coal. Exactly. Yeah. And even there's subsidies and everything to help them. Even half of the money can be funded for a gas system. That half is still way too expensive. Yeah, and the bank will not lend them money. There you are. Either as whole society, we upgrade those houses, but then what are we doing? Are we going back to state communism? So this is just a very difficult society problem. And the returns on investment, you will not have them. You will have maybe the return on health, but not necessarily on money over the next 10, 20 years. And that makes the story very complex. And I'm on the, we will see in 20 years who's right, but I'm more on the fence that this will take longer. with weak business cases on the clean energy side.
Yeah.
So
yeah, I think renewables will play a big part in the future, but the key word is future.
And that's why I have Iberdrola. And by the way, I bought them, I think, for 11 euros last year, and then for 15 euro, and now they're 19 euros. So there are companies that do it really well. And Iberdrola is, I think, one of those exceptions that is extremely well performing because the cash flow underneath is also really strong. So it is possible. It is possible.
Yeah, it is. It is. Look, let's see how this plays out. I completely agree with you on the whole oil energy narrative. Actually, I'm hoping this Venezuela business will drive a bit more volatility because it might create some opportunities to buy more in that space. I'm actually underexposed in the US space. I've got EOG resources, but I think I'd like to add some, maybe Chevron or something because, quality companies. Anyway, no real dividend announcements. What is going on in 2026? It's 10 days in and we don't really have much to talk about dividend hikes.
True, but I did already update my dividend income sheet. So Nike was paying dividend, HB Inc. was paying dividends.
VG Properties pay dividends.
VG Properties. So, and that's what we care most about. Yeah, the hikes will come because by the end of January, in 2 weeks, the first European companies will start to announce. Yeah, typically the pharmaceuticals in the last week of January, and we'll get the first dividend hike. So stay tuned, Derek. There will be fireworks in February. And do you have any hope for a dividend hike? Where do you need the most?
Any hope for dividend hikes? Actually, I think I'm okay. My top positions are basically in insurance, which have done quite well in terms of dividend hikes. ASR was pretty big last year. VG is up there. So I expect them to be lower when they eventually do that hike. It'll be much, much lower.
I do hope that Shell will do more than 4%, honestly. I hope for 7 or 8% this time. Yeah, they've been buying back so many shares. So they are lowering, of course, with that their absolute dividend payments that they need to do out of cash flow. But I hope that they will give a little bit more. Now, I think we deserve that as shareholders. I'm very curious about Ahold Delhaize, actually, and what they can do from a dividend hike point of view. They're still doing the 1 billion buybacks, but the share price went up quite a lot. Will they continue to stick to 1 billion? Because that means less share buyback. Maybe they should award a little bit more to the dividends here at these prices. I'm very curious about Danone, because they started to perform well again. Will we now see a proper dividend hike, as an example? Unilever, I'm quite curious about, but they have a quarterly dividend, but I also think it deserves a proper hike. Yeah, and the insurers, they have been on fire last year again, right? They have so much cash on the balance sheet, so I wouldn't be surprised if we get an 8-9% dividend hike there. So this year, I hope for a little bit more hikes than last year.
Yeah, I'm looking forward to seeing Manchon Machine this year and seeing how they perform. I don't know if the hike will be big this year because this is their year after the transition. So maybe next year it'll start to pick up. But I'm interested in that one.
Yeah, and then we have a company like LVMH who kept the dividend flat, if I remember correctly. So there as well, which actually, I mean, talking about the company here, I think I bought in the last tranche at 400 euros. They're now 650 euro. I mean, there have been so many. If you think that the market goes up in a straight line, look at all these companies, right? They really had big dips last year. There were quite some opportunities.
Yeah. And there'll be plenty more this year. No doubt about that. Okay, so this week we're going to have a look at the community portfolio. I remember last year we had this kind of, I don't know if it wasn't our idea. Somebody maybe mentioned to us on Facebook that we should have this community portfolio that was created not by us. So we did not pick any companies in this. It was created purely by the community on Facebook and on Twitter. We didn't have Discord at the time. So it is 10 companies, 10 dividend growth stocks. What I did at the time is I created a trading 212 pie. I invest €50 a month into that, which is just for a bit of fun and just to keep it so we can track how the performance is doing. I say fun, but it's still money at the end of the day. It'll still pay me. What was quite interesting about the pie, and I'll get into the holdings in a moment or two. But what was interesting is the rate of return since we started this pie until yesterday, which was when I grabbed the data. the rate of return was 15.6%. Okay.
That's a lot.
Yeah. When you look at the rate of return of the S&P 500, which according to the Carson Group, they had this S&P returns over 2025, was 13%, which is quite good. So you think about it, we're 2.6% ahead of the S&P 500 in terms of rate of return, which I think is
wow.
quite impressive.
The wisdom of the crowd of the Dividend Talk community is next level. I mean, kudos to everyone. I mean, we have a bunch of smart cookies in the investor community. This is crazy when you think about it.
Look, we're not surprised. We see day in, day out the conversations that are happening. So we knew that it was going to be pretty decent in fairness. Yeah, quite. I'd be quite happy. Like we got asked the question about a core holding before of companies, and I think this portfolio would probably be as close as whatever I would pick to.
Okay, so tell us then what's in there, because you're making us curious.
Yes. Okay, so it's in alphabetical order. Okay, so we have Agree Realty, ticker symbol ADC. We've got ASML. We've got Automatic Data Processing. We've got Johnson & Johnson. We've got L'Oreal. We've got Louis Vuitton, Moet Hennessy Louis Vuitton, LVMH. We've got Microsoft. We've got Realty Income. We've got Shell. And we've got Visa. There was one company in the original list, which I still hold. So the pie technically has 10, but there's one that I haven't sold. It's still there, which is British American Tobacco. But that was removed in the beginning.
But they had a good year.
They had a great year.
Oh, remember that they were at like 23, 24 pounds per share and then all the way to 40?
Yeah, they've done really, really well in terms of share price in my portfolio. But
yeah,
it's quite good.
But this is a great portfolio. And by the way, I'm so biased because I own 9 out of 10. I only don't own Visa. Yeah, all the rest I own here to a large extent, some ASML not, a very small position, but these are very high quality names. So think about Agree Realty, just the first one, right? If we go a little bit in alphabetical order, I think this one still has a lot of opportunity if the interest rates go down, in this sector. So it's a company that's still quite well positioned. I wouldn't say that this is an overvalued company or something like that. Maybe as the likes what you see in the Mac 7, the multiples. This is still very reasonable. Priced.
Yeah, but it's not a screaming buy or undervalued. It's not.
No, that was when it was around $50 for a while, right?
Yeah. So I mean, it's trading at around $75 now, which a part of me, I have a decent position in Agree Realty, and sometimes I want to add more, but then I look at the price at 75 and then compare that to Realty Income, and sometimes it's a bit of back and forwards. But then, like we have Realty Income in this portfolio as well. Yeah. I prefer Agree Realty. I think they have a better growth profile. I think our key goal for this year is to get Joby Agree on this podcast. Let's do that.
Let's do it.
Let's set.
Yeah, Agree Realty has a much better runway, I would say, and they are doing very well the acquisitions. I mean, if you see him, how he also explains why they are, for instance, choosing certain customers or not, and then compare that to Cebus, which is doing massive acquisitions, but bottom line, not a lot, So for me, Agree Realty has one of the better CEOs or best CEOs in the entire REIT space, I must say. Learned it from his father, I think, and he mastered it, But then ASML, now it's going towards €1,100. It's a stock that also caught a lot of attention in the US part of the world because what's his name? Carlson, Joe Carlson. He is a big fan of it. He talks a lot about it on YouTube. I think it went to €600, now almost €1,100 for such a company. I think it has a 14 or 15% weight in the Dutch Amsterdam Stock Exchange.
Wow.
So, and I think they are reaching 1,000 points almost soon, a historical milestone. But that's mostly because of ASML, of course. So if ASML gets a little cold, then the whole Dutch stock exchange is getting sick. Yeah.
Yeah. Of course. I mean, it's such an iconic company, especially from a Dutch perspective. We did analyze these, and they were 692 at the time, and now they're just over €1,000. So, I mean,
and Does it worry you, for instance, the news that China had something also running there?
Worry
You
is,
see that news?
yeah, I remember we spoke about it last year as well. I mean, worry is a big word. I'm not too worried. I think eventually there will be some competition, but I think that ASML's products are so unique. This lithography, it's so unique, and they are known for the quality of their products. They're used by all the major chip manufacturers. And when you have a large amount of capex to spend on new equipment that you're bringing in to test your product,
Yeah.
I mean, I'm putting my manufacturer hat on me. What do you want? Okay, do you want something that's proven? You might pay 10, 20% more. Or do you want something that's not proven, that's 10, 20% cheaper, but you're unsure of the quality and how it performs long term? So, I mean, you might have one or two customers that will choose the second option, but I know I would always choose the first.
Yeah, but that only works until it's proven. Yeah, and
exactly.
they will have the time for that, but it puts a delayed effect to the impact of ASML. I think what the main differentiator is like you need a whole university of PhDs to get one such device installed.
Yeah, but I mean, look, China has.
So it's too complex. And then if you think about also, because we talk now about ASML, but for instance, you need to do business with Carl Zeiss, for instance, for the lenses and everything, right? So what I'm trying to say is like, it's not like in China, they need one company. They need a whole supply chain with extremely high science and engineered products, like on the edge of innovation. I think that's the hard part. That's really the hard part because you need so. And I wouldn't be surprised if you look at the supply chain and you're talking about 10,000 PhDs that are all contributing to having one such device installed and built, manufactured, right? I don't even think that a single individual with a manual in their hand can reproduce it, even not the smartest person in the world. I think you need these teams there. And to reproduce that is very hard, very hard. And in the meantime, ASML is also innovating. Yeah, they're already looking at 10 years beyond before the next step. So I think this mode is one of the strongest in the world. But you always need to watch out for competition. Look at Tesla and BYD. BYD is now, I think, having more sales in Europe than Tesla at the moment for multiple reasons. But it's a simpler product. But still, once China gets a grasp on something, they're unstoppable.
Yeah. Look, I think given the importance of semiconductors in general in the modern world, I think it's inevitable that they will get competition.
Yeah.
But if you look at my investment time frame, when I'm buying a company, it's usually 5 to 10 years. I mean, I can't predict what's going to happen in 20 years. I think within the next 5 years, I don't see competition.
Exactly.
In the next 10 years, I think it's unlikely. If there's something there, it will not take a huge market share of them at that point.
Exactly. Same here.
Moving on down to the list, and we've got automatic data processing, and that's a new company in your portfolio.
Yeah.
I'm
so happy because it didn't do well in our portfolio, in this community portfolio. But yeah, I'm really like this business. I did in our latest newsletter from last week. I did a comparison between payroll providers, our payroll solution providers. And yeah, for me, ADP stands out here still. It's probably the largest, but it still stands out. They have a really good business model and execute very well. So I just own too little of it. Yeah, that's the thing. So I'm patiently waiting, but I'm quite convinced there will come opportunities again here. I've got at least the initiating position. I like it. So together with Paychecks, which has a much higher payout ratio, but they have similar earnings yields. I think I have two strong players in my portfolio.
I would say so. I mean, any company that pays a dividend or grows its dividend for 50 years can be considered strong. But yeah, always an interesting company. I remember it's one of my biggest lessons. I bought them way back 2018, 2019, and sold them when they rose about $10, thinking they were overvalued, and now they're.
We all made those mistakes, Eric. Myself as well.
Yeah.
Know what I did with McDonald's. So
yeah, of course. Everyone has to make their mistakes.
Yeah, the issue is you sound smart at that time. Yeah.
Yeah, I mean, like you do your analysis. I mean, you get better at that over time. And I look back at what I wrote in the beginning, and it's kind of top level. You do that, and then it goes up in share price. You think you're right, and you go, okay, I'll sell and get profit here, and
yeah,
job
exactly.
So you live and learn. Couple of others. So Johnson & Johnson, We
The
talked
comeback kit of the year. They ticked on $200. Like, I mean, Johnson & Johnson is literally like this football player that quit at 32, is called up, comes back at 34, and then wins a World Cup or something like that. That's Johnson & Johnson for me. Amazing. I mean, in terms of share price development, this is crazy. I'm so happy that I loaded up when it was around fair value, because Johnson & Johnson, ADP, those are for me companies where really this mantra of buy high quality companies at a fair price applies. Yeah, Johnson & Johnson has been trading for a long time at a fair price. We always say like there's more portfolio risk now in there because of the spin-offs of some businesses. But ADP is the same. It's a high quality business of a fair price. You will not see them quickly in a discount. Yeah. But then see how Johnson & Johnson is being beloved by the market again. And nobody talks about Johnson & Johnson, right? In the community, nobody. Yet they are. There they are, a very strong performer last year.
Yeah. And remember, and we were guilty as well, I have to say, we were talking about the change in their structure, more of a medtech company, but also you can't forget about the legal actions that they had against the talc powder. And a lot of that negativity at the time was there. And that's where your conviction comes into play.
Yeah.
I mean, if you have strong conviction, they are the times to buy because they're opportunities, which you can see in terms of share price, and they still hike their dividend around 5% every year.
It's simple. It's my 6th largest position. I've been using that opportunity to buy with I now have an average cost per share of, let's say, because I need to translate from euro to US, I think around $132, and it's trading at $204, and it's giving me really nice dividend income, and I have a yield on cost of 3.7% for some company that hikes the dividend by 6%. Yeah, not too bad.
Not too bad at all. Not too bad. As I said, based on last year when there was a lot of uncertainty, we also mentioned, if I'm going back, about the pipeline. I think you mentioned that it was unimpressive. I think the words that you used.
Yeah.
Is that still the case?
I will need to analyze with the next annual report. I do that once a year, so I can't tell you that now. I will need to analyze that.
Perfect. Okay, and then some of the others, L'Oreal and LVMH. You wrote about both of them, 2 deep dives in our premium newsletter, so you're better placed to speak about them, I think.
So L'Oreal just continues to compound. I think L'Oreal is one of those companies that's actually be able to deal quite well with the China markets. Yeah, so, and that's a positive. I initiated the position, I think, when they touched $300 at a certain moment in time. I don't know what they're doing now. They're 344. Yeah, is that right? 344, is that what they're trading now? No?
L'Oreal are trading, about 380.
385. Okay, so my average price is 344. That's what I'm reading here. Okay. So they're just compounding, doing acquisitions again. So they're just doing what they're always doing. No news from the rest, as they said in the famous movie. LVMH, on the other hand, are of course very much impacted by the wines and spirits business. Yeah. So and also China. There's a little bit of anti-Western sentiment from what I understood there. So they're having it tougher. But I mentioned earlier, the share price dropped to 400 euros. Was a good time to acquire. If you wanted to have any more confidence, also the founder and CEO was acquiring a lot of shares at the time.
Yeah,
he's a pretty smart cookie. He's one of the richest people in Europe, so I would not bet against him necessarily. And he's a shark as well. So So this is a company that has much more cyclicality in it than L'Oreal, I think. Because of the nature of some of their products. It's also not that premium as Hermes, that is really for the ultra wealthy either. So it's right in between there, I think. Yeah. I mean, those are things that you buy them once, put them on the shelf, and you look back after 10 years.
Yeah, exactly. And look, we have a couple of more companies on the list. We have Microsoft, which we speak so fondly of on the show. I don't think it needs much attention from us here. I do technically have shares, as I said to you, in trading 212 in this pie and in another. So I am a shareholder. But the last company, maybe your thoughts on, because it's the only one you don't own. I technically own all 10, but Visa.
Yeah, very, very great business. I had one time an opportunity to buy them at $180 when it dipped. It was $185, had my buy price ready. It just never triggered it. That's where sometimes my strategy that in 80% of the cases does me well, sometimes not. So it flew away. That's Visa for me. I think it's a brilliant company, very high margins, can reinvest in the business very little but grow very fast still. I do think it has more threat coming up than people may give it for in the terms of like the payment system. Also in Europe, Europe announced that they want to have their own payment system. People make a meme out of it. But I know we have some Polish listeners. We have Blik in Poland. Yeah, and you can just really easily with a code pay everywhere. I can even transfer money to a phone. It works so good. And I'm sure it's at a fraction of the cost of Visa. So what I want to say, only the technology exists already. We just need to scale it to Europe and it will be a game changer and will be very hard for Visa. So there are serious threats in there, I would say. So people can make a meme out of it. But if in Europe there will be a little bit more positive sentiment, maybe by scaling something and a little bit less national interest, they should just take on Blik, scale it to whole Europe, and Visa would have a serious issue because they, of course, they charge really high fees to the merchants, right? I think you had a business, so you're probably very much aware of this.
Yes, it was painful.
Yeah, exactly. So if we would have a Blik European system, it would erode their whole business. Yeah. It would erode it. So that's the risk that I see with Visa that I think sometimes is underrepresented. That's why I think the valuation is just not justifiable of where it trades. But of course, at today's performance, probably it does. But maybe if my feeling is wishful thinking. But that's why that's the reason why I'm not just jumping into Visa at all costs.
Yeah, I get you. But they're so integrated with all the major banks. So we need a fundamental shift away from traditional banking, which is happening. We got a lot of fintech banks. You got
exactly. I think it is changing.
We got Revolut, for example, which we increasingly use more and more. In the US, they've got Sophie Technologies, I believe, which is a fintech. So it is changing. But I think Visa are probably good enough to change.
Yeah, and the one benefit they have still is that, for instance, Google Pay and Apple Pay make it so easy to add a credit card or a debit card, and you just with one click on your phone, facial recognition, you paid. It's the Visa infrastructure below it, right? In most of the cases, or MasterCard. So there is, of course, a very strong mode there. But I would applaud that Europe invests a little bit more in their own tech scene. And I think the financial market is ready for disruption because the fees are too high. That's how simple I look at it. And companies as Wise are also, I think, proud European companies that we should pay more attention to. But now I'm coming to more like wishful thinking probably than reality.
Yeah, and I don't know if it's completely wishful thinking. There's definitely a case there, but still a quality company. And if you look at that dividend growth chart,
it is. Let's not be mistaken. Yeah,
chart's amazing.
But the issue for me is always like how to spot Visa at the time that it was just about to have this growth. Yeah, because some people say like they look at Visa and say like, no. If you would have invested in Visa 10 years ago, the 1.6% yield, look at your yield on cost now. Yeah, how many Visas are there? That's really a survivorship bias, yeah?
Exactly.
It's so hard to spot those companies today where you can see this runway for the next 10 years, yeah?
Yeah. And it's easy to let that thinking make you biased into buying Visa now. But we can't guarantee they're going to do that for the next 10 years.
Exactly.
And that's my problem with Visa. I mean, look, I am technically a shareholder. It's a very small position, but I would have the same concerns, which is why personally I looked at them for a long time. I've always teetered on the edge, but to me, the valuation was just always a little bit rich. They justified it with their growth rates, but I don't know.
Yeah, but then the yield is not compensating enough for what if you are wrong.
Exactly, which is quite possible. Anyway, that's the dividend growth portfolio that was picked by our community. As we mentioned, look, it's a pretty strong portfolio all around. It's probably, if I was to pick a beginner's portfolio, I say beginner, not even a beginner,
Yeah.
but if I was to pick a foundational one,
This would be it.
it would be close to that.
And it's a
possible.
nice mix of European and American.
Yeah, which reflects our community. We have a good split between both Americans and Europeans, so it's a nice mix. Okay, we have some listeners. I actually thought today was going to be a shorter episode, if I'm honest.
We're at 15 minutes, yeah, but there happened so much this week.
Yeah, so we have quite a few listeners' questions as well. There's a couple that we've taken out because they require a lot of time. I know yesterday we didn't have enough time to review, so we did it this morning. So we took out anything that needed a bit more of our time and we'd maybe put them in next week. One of them we're going to do a show on and we'll go from there. But we will start with a very, very nice question from Marco. And he is asking, what are your thoughts on the latest shareholder letter from Fundsmith?
Yeah, and thank you for bringing this to my attention, Marco. So actually, that's what I use most time in preparation for the show today. I spent half an hour reading it. And first of all, this guy, I just love reading him. Some of his commentary is really funny. I'll come down to it. But hey, bottom line, this was a difficult year for them. And therefore, people were really, really looking forward for the shareholder letter because he could really lose a lot of reputation now, I think. And that's probably where the question comes from as well, because they grew their portfolio by 0.8% in 2025, while the benchmark MSCI World Index, both also translated back to pounds, did 12.8%. Still, since 2010, its inception, it outperformed by a decent margin. But you know, that margin is getting slimmer and slimmer and slimmer at the moment. But what is more interesting for me is the arguments used why this is. And before I start explaining them, people that have been listening for 6 years to this podcast will know that I'm often citing the same kinds of concerns about the stock market in general. So I'm already biased because I pretty much 95% align with Terry Smith's thinking. Now, does it suggest that I'm that smart? I'm more proud that I can even get the same arguments sometimes. I see the same patterns as legendary investors say. So I think it says two things. We're both value oriented in things and very curious. But let's not be mistaken. I'm far from his knowledge ever. So that's why I'm so proud that I see similar patterns. So a few things, three main reasons. One, the Mac 7 stocks are having a high concentration in the index now. 39% of the S&P 500 is giving 50% of return. He's talking about the top 10 stocks here. This has not been seen since 1930, this kind of concentration. Now, you could think like, no, who cares? Just buy S&P 500 and you outperform, right? But this is where I like really the point that I fully align with. He says like, okay, but that is my philosophy would then be to go full in on, let's say, the whole AI hype and LLMs, like all in with my portfolio almost. It says like, this is like, this would be the same as like, okay, I'm going to buy the 5 drinking stocks in the world, like Diageo, Pernod Ricard, full in, and then I will beat the index. I said we're managing a portfolio, not a sector bet. That's his mentioning here, and I think he's right. So this maybe because of that, this is one of those years that it underperforms, but maybe in other years it will outperform if those stocks come crashing down for whatever reason at some point in time. Yeah, because you're then not either overexposed. Which brings to the second point, because you could say then, okay, so but if this is so clear, then why don't you become a momentum investor? Yeah. Buy low, sell high. Of course, that's not easy, first of all. But what his point, the second point is here now, since 1 or 2 years ago, more than 50% of all stock ownership is passive via the large institutions that are running index funds. And I've been talking about this as well sometimes, that I'm a little bit scared that if we would have a crisis, that we see so much more volatility because consumers, retail investors are massively selling out their index funds. And you throw out also the baby with the bathwater. So But in a time that there's only being cash deployed to the stock market and ETF and chill, it means it just buys all the time at whatever valuation. It buys Nvidia, also Tesla, whatever. What is the multiple? 300, 100? I don't remember. So you just keep on pouring money on top of it. And research shows that there is even a leveraged effect in that if you throw that in the top 10, that the top 10 even becomes stronger compared to the rest. Yeah. So it's like you're even getting more and more concentration because of that. What he is effectively saying is that index investing is distorting the markets because its core function of the markets has always been a mechanism for valuing companies, raising capital, and providing liquidity. You can't talk in such a market really about valuing companies if you just throw money and money and money and don't care about the value at all, which he feels is leading to a misallocation of capital, where you could think that this time is different at a certain moment because the valuation of companies just get higher and higher and higher. And we know what what those words mean. Although he mentioned that maybe there is a little bit of this time is different because he referred to the 2000 time of the bubble when only 10% was held by passive indexing. So therefore, there was quicker a punishment if things didn't go well. So maybe the time different now is that this can take longer there. But yeah, if it comes, it can hurt really much. What he also later writes in his report, really simple, he has a few metrics that he looks at, like cash conversion, yield, earnings yield, or something like that. Yeah, I mean, that looks very strong balance sheets because of the interest coverage ratio. So this portfolio is just very strong. And I think if there would ever be a crash, these stocks should be least hurt because this portfolio should be least hurt because it's so strong, high margins, strong balance sheet. They have a lot of optionality what's in there. So I think it's a very strong setup still. That's my thinking here. The third one is dollar weakness. I mean, not need to say anything about that anymore. So I'm actually fully much understanding him. I'm with him. And I think if investors now sell the fund because of this underperformance, it depends again if you're a long-term investor or a short-term investor. I just expect them to outperform more if this starts to reallocate again.
Yeah, yeah. But what you got to remember is if you're a shareholder in his fund, it's 5 years in a row that he's underperformed.
Yeah,
which is difficult from a psychological perspective.
Exactly.
I think as an investor, what I admire about him and the fund in general is that they are sticking to their guns. I mean, you talk about conviction, you talk about a plan, you talk about knowing what you invest in. He is the shining light. He's a big example of that. And he come out and he's pretty straightforward with that. But when you have your hard cold cash in that and you're looking at his fund, and you're looking at the fund next year making 13, 14, 20, 30%, it's quite difficult to stick that out, I would say. But
yeah, but if you look, but now we're talking about total, but if you look at the fundamental part of the portfolio, it's super strong. It's super strong. Even Novo Nordisk, which he also spoke about. And this is why I love this guy. Novo Nordisk managed to reaffirm my belief that you should never say things can't get any worse. One of our mantras has been that we should always invest in businesses which could be run by an idiot so that performance is not heavily reliant upon management. We have been made painfully aware that range of business which can be run by an idiot is much more limited than we thought, and hereafter we will aim to be more aware of the impact that poor management can have. And what he also says, our experiences also suggest that when we encounter poor management, engagement to change it is less effective than selling the shares. I love this. So, don't even try to change management because ain't gonna work. Yeah.
I mean, as a person, as an investor, I think he's fantastic. I think he's a breath of fresh air in this.
Yeah.
It's a convoluted space at times and there's a lot of jargon and finance jargon, but he just breathes a breath of fresh air out there and just says what we're thinking.
Even then also later, right? Coloplast is another Danish medical company. This time in devices rather than drugs. Once again, the CEO has been ejected and we wait a replacement. And then the snarky comment, perhaps there is something in the water in Denmark. So anyone that's listening from Denmark, maybe we fly all to Copenhagen this weekend, upcoming weekend, yeah? And we have some Danish friends coming, and I would love to know on our meetup. Please, let's discuss this. What's in the water of Denmark? And let's respond and send an email to Terry Smith to explain him to them. Maybe someone can bring a water sample with a purifier to see what's really in there. Maybe we can do an analysis and we will send him the results. So if you're from Denmark, take a sample. If you're coming to the meetup and you know how to do this, to analyze a water sample, take your equipment with you. We'll analyze it and we'll send him a letter. Yeah, let's do it. Let's do it, because this, I think, was a genuine question, or one. Terry Smith is really, really interested about this, and I think we should. He gives so much back to society with sharing his wisdom. We should share this to him. We have the community, we have people in Denmark. Let's send back an outcome of the water quality in Denmark.
Okay, let's try do it before we have some Diageo products. It might be a little bit more interesting if we're full of Guinness and sending a letter to Terry Smith.
Yeah, exactly. I've really enjoyed reading the letter. So thank you, Marco, for bringing it up. Thank you. It really was a joy, and I align with his thinking. I think I have the same patterns that I see, and it's not hard to not see it. The impact of index investing and the concentration. Anyone that wasn't invested in the next 7 has probably underperformed this year. Yeah, unless you were in a few speculative growth stocks. But if you had with our kinds of portfolio, you can't keep up with that. It's simple as that.
Gordon has asked a question about reconciling the cyclical nature of the oil and gas industry with the reliable and attractive dividends by the oil majors in your portfolio.
Do you understand the question entirely?
Not really. No, I thought you had stuff wrote underneath.
No. But that's why I'm asking first to you. So, Gordon, what I think that you're asking is like, aren't the dividends always at risk due to the cyclical nature of this business? So, is there really dividend safety? So, I think with the oil major, yes, there is dividend safety because they have such strong balance sheets and they manage across the cycles. You did see Shell cut the dividend in 2020 because since the Second World War, it came to a level during the years that it was not sustainable anymore. So the dividend was at risk, and we even saw that, you and I, Derek. But generally, no. That's why if you look at the cash flow through the years, it's very well managed, and they leverage up a little bit during a cycle. They've had many cycles, so they are experienced with it. They literally have a playbook for this. So I'm not too concerned. It's one of those industries where management knows that dividend is probably their only real return that a shareholder will ever get out of the business. So no, I'm not too concerned about that. I don't see the same behavior in BHP and Rio Tinto. You see there much more volatility. But look at ExxonMobil and Chevron and the dividend history. Even Total Energies, the dividend history, it speaks for itself, and the balance sheets are still very strong. So yeah.
We got a question from Fairtrade, and for a long time, they have been considering building a dividend portfolio of stocks, okay? But at the same time, the challenge that they have is that they always come to the conclusion that having a long-term portfolio of ETFs, distributing ETFs more specifically, is always better. And he gives 2 tickers. He gives FTWD and WEBG. So he's asking us what we think. And in my opinion, and I think we've said this, for the vast majority of people, if you think of the average Joe that does not have a passion in reading annual reports, looking at financial figures, ETFs are probably better. So yeah. I think if you have this doubt in your mind, then stick to ETFs in my mind. I would not waste my time because, I mean, you have to put it's not passive investing. You have to put in a bit of work when you are doing what we do, which is investing in individual companies. It's not hard work, especially if you enjoy it, but if you find it to be a chore, or if you find that ETFs are just generally better, then it'd be much better for you as an investor. You'll sleep much better at night.
But it comes generally at a cost, because most distributing ETFs, and I'm talking here about UCITS available to Europeans, don't grow their dividends year over year. And often they had already flat dividends for 4 or 5 years. There are few exceptions to that, but don't think necessarily that you will have a dividend growth portfolio due to the ETFs you own. Yeah, there even if the name Dividend Achievers is in it or something like that. There are a few American. SEHD is the one that's really growing it. And then you have the FUSD and such based on US Dividend Aristocrat, but typically the yield is very low, more like the S&P 500 there. So, but if you want to have a decent yield and growth, it's very, very hard to find. It's really trying to find a needle in a haystack.
Yeah, but outside of dividend growth, if you're looking at total return, ETFs
then
be fine.
Exactly.
Absolutely fine. My Taran has asked about a portfolio of a certain amount of global index funds and withdraw 4% annually and leave the rest in high yield stocks. With the index fund, you get growth and you can skip the low yielders, and with your high yield stocks, you will get some income.
Yeah. Yes, that's good.
Yeah, I mean, it's similar to what we said above, isn't it? I mean, there's definitely a place in that. I think where I struggle personally, and I've mentioned this on the show, is Ireland's laws around ETFs is much different than Europe's. I mean, we've got crazy things happening. We thought that the deemed disposal rule, which is a rule where we have to pretend to sell our shares in ETFs every 8 years and pay tax on it, we thought that was going to go this year in the budget. It didn't. It's still there. And then there's other disadvantages, like if I can't tax harvest with ETFs, I can with individual stocks and so on. So there's and also different tax structures. So I see the merit behind it. And I think if Ireland's laws were more like America, I think the bulk of my portfolio, 50% would probably be ETFs and 50% dividend. But
if I would have access to the US dividend like SCHD, and I know we can get it via option trades and everything, but it will be a cornerstone of my portfolio as well.
Yeah. If you could buy it and sleep well at night, knowing that it's not at risk to some loss, exactly. So yeah, great option, I would say, for that strategy. Thomas has said, what do you think about the concept of investing in two similar stocks when investing in an industry? Does that sound like a good investment here? So for example, we spoke about Visa. What if you bought Visa and MasterCard? Or
I think for many industries, this is a good thing to do. Unilever, Procter & Gamble, Paychex and ADP, Shell and Chevron, or Total Energies and ExxonMobil. Well, yeah, I think often the pies are big enough for two strong players in your portfolio, and you don't need to necessarily always bet on one horse. Some people will say that means that you have a lack of conviction. We have an interesting piece in our upcoming newsletter about this, about diversification versus concentration. There are, I think, different schools of thought. I'm more of the schools of thought like, just accept that you will not be able to have the same information at hand as the CEO. There's always an information asymmetry. So while we say you need to have conviction, right? But I don't mean with that you need to have conviction that you know everything. You need to know what you own so that when the stock market goes down, you don't chicken out too fast. That's what, for me, you can't borrow conviction means. You need to do some of your own homework, but it doesn't mean that if you don't diversify, that you don't have conviction in your holdings. That's, for me, something different again. That's more like, do you feel comfortable with such a concentration of only having 10 stocks? And then I am a bit more humble because there's information asymmetry. I'm not sitting with the CEO. I'm not walking into the office. I don't get the nonverbal communication of what a person it is. Can I trust it? So we are always doing with published reports, secondhand information, which means that you're always behind and not. You can't say like you know everything.
Yeah.
Look at the high conviction pieces we have seen on evolution, on hims and hers, and on social media, and look what that did to shareholders. Yeah, and people sold then, like even writing why they don't have conviction anymore. Yeah, because you just don't know sometimes. Yeah, just accept it. Be humble.
You can't know. So that's part of the problem. And I think part of that is understanding the risk as well of what you own. What can go wrong? And what will you do if that happens?
It's much more risk management at times. True.
Josh has asked us, at what point would you stop reinvesting dividends into a stock and reallocate those dividends elsewhere into another company?
When I have a full position.
Yeah, pretty much. Hussein has asked us about a specific checklist that we have to assess a new company before initiating a position. We have 5 broad questions, which we spoke about dividend safety. I spoke about it last week as well on the show. The 5 simple questions, but within that, it's complex.
And then that's why there was also this week on Twitter someone saying like, oh, if you look at these metrics from Buffett, and you'll be kind of fine. That was a suggestion, but there's a lot of nuance to that, because you can say, for instance, earnings growth or something like that. Yeah, but if you're looking at REIT, you're talking about FFO. Yeah. If you're looking at insurance company, you're looking at other metrics again. So that's why I like more the general questions, because then based on the companies you're analyzing, you will typically use a little bit different metrics within there. Yeah.
I think once you own a position, once you're doing that full fundamental analysis and full deep dive, you know the story of the company, you understand some of the nuances. I think then you can probably tailor make your metrics to that company that you can look at, and then maybe pick red flags. But I think picking a company based on metrics is quite hard, because there's always nuances. You might look at a company with a high debt to equity ratio, for example, but there might be a reason for that. They might have just done an acquisition and they might have an aggressive strategy to pay that down, and you might skip that company because you look at a metric and go, oh, their debt is too high. So I think metrics for me come after you do the deep dive analysis.
Exactly.
Thomas has asked a really interesting question. It's a long question, but I'll just keep it short. He's been looking at some of these consumer staples. So take Procter & Gamble or Unilever, for example. He had a thought in his mind that the global trend of brand power erosion is quite real. So his whole question is, do you think that this is changing, or do you still believe in the power of brands?
Of course, I believe in the power of brands, and I'm somewhat aligned with him. And again, these are just opinions, right? I'll probably be wrong, but my thinking at the moment is that after COVID, there was so much cost inflation that those brands have been passing it on to the consumer, but it reached a level that the consumer now needs to make choices because their salaries didn't increase that much at the same time. So they now need to make much more choices. And then the home brands, the alternative brands for half the price become much more attractive. So what I try to say is like a good brand has only so much pricing power. And then there's price elasticity in let's say in economics, where if you price a little bit too high, your demand goes down. I think we're at that stage where many companies have been overshooting a little bit because they want to make the EPS still look good. But then the consumer just starts to make choices. And I give you a very simple example. There was a time I had my cable subscription for television. Let's say it cost me 40 euros. Yeah. Then we switched to streaming. Oh, Netflix, 10 euros. Yeah. Netflix, what is it now? 20 euros, 15 euros, 20 euros. But then I only get a little bit of content. I also would like to see football. I need Canal Plus, another 20 euros. Then I want sometime watch another movie. Oh, I need Disney as well. Oh, and HBO, there's a new series there. You're talking suddenly about 100 euros per month. You need to make choices. So what do? You start canceling those subscriptions again. And this is the same with the Lay's chips. If I see that they're costing 3 euros a bag here on the corner, and I can get the home brand for €1 back, at a certain moment, you start to make those choices. And this is, I think, where pricing, also for superior brands, have limitations. Otherwise, they could price it into the sky. And that's just not happening. So, and that's what I more see.
Yeah. I mean, you can look at this from different angles. He spoke about consumer staples, so we'll stick with that. I mean, obviously, have brands like Nike and Adidas, which is a different concept. But I think if you have a well-known brand in that space that's on the shelf in a supermarket, and you push the point to a price where the consumer in their mind is thinking about making a choice, that means you've lost that customer. They're going to go to the cheaper option, to go to the brand.
And consumers are typically price anchored for the products they buy a lot. And they see the bill. So there's a lot of feeling like, Jesus, I just only bought 10 products and I paid this. Yeah, because they see their bank account going down faster. And then they start thinking, where do the costs come? And they start looking. since when do we pay this for that? Yeah, and that's how it starts.
Yeah, exactly. So I still think there's something in brands, but I do think in the macro environment we've come off. Remember the last few years we've had COVID, then we've had inflation, then we've had high interest rates. It's just been a really tough time for consumers. So you can see why brands are struggling at the moment. But eventually we might have a recession. Who knows?
But the brands will stay. The brands will stay. But what is also very what people need to be aware is customers are not fools. Think about shrinkflation. Yeah, what's been happening? Many of those same companies have been playing tricks with consumers.
Yeah, but as soon as people have more disposable income, that's when brands will be more powerful.
Exactly.
Keeping up with the Joneses effect on that.
Yeah.
Ryan has asked a similar question about the ETFs, but a more personal question. He is looking for advice for someone transitioning from accumulating ETFs into dividend growth stocks. He really likes the strategy, but he's finding it hard to switch from a total return mindset to focusing on more of a dividend income one. And I think it's a similar advice to what I said above. I mean, if your mindset is not in it, if your mindset is not dividend income, then don't do it, because you're going to regret it. There'll probably be tax involved in this if you're going to sell your shares. Maybe keep your existing portfolio, start a smaller dividend income one and see how you feel about that. But yeah, I get it from a mindset. It's hard to shift from one to the other. So I would do what you're comfortable, do what helps you sleep well at night, I would say. That's the best advice I could ever give anyone. And it seems like you're struggling with the mindset already. So I would definitely not change my portfolio. I just start a smaller one and see how you feel. And if it works, it works. If not, then your core strategy remains the same and you can still sleep well at night.
Good. So Derek, we have now 5-6 questions about stocks related, right? Let's do a lightning round. Let's do it really quick because I see we're on 1 minute and 15 or 20, something like that. 1 hour and 15, 20. Let's do a lightning round.
Go.
A.T. Beer Snyder, what are your thoughts on NVO share price, Novo Nordisk to recover, and how fast do you think analysts will start revising their targets?
Quite fast. I think that they will increase their targets because the price is going up the way again, and they will probably in January, they will revise their targets up again.
Okay, so a lot of momentum for this share price coming up. Good for your options. Next one from El Cuba. What's your thoughts on Discord's IPO, and are you going to invest some money after being listed?
No, I don't know how they would make money, and I don't understand it enough, so I would not invest in it.
Good. By teenagers giving gifts on streams, that's probably it.
Not a good.
That they can share out of that.
Not a good enough model for me.
No, will be regulated.
Yeah.
Next one from Jean-Christophe Debray. His question about Euronext. So more to me, he loves the company, would like to buy soon. However, there's one thing troubling him. He sees that the return metrics are pretty low for a company with such a moat. If you compare to competitors, I think you need to go a little bit more down to it. So, Jean-Christophe, if you have specific metrics that you are using, please ping me and we can compare our data and then see what's there. Maybe I don't see something, but on my end, they look quite good. So I think what you need to know is that the acquisitions are impacting a little bit the latest returns there.
Cool. Richard also asked you a question. As a fellow Shell lover, if they are not ready a full position, would you consider adding more? He's a bit price anchored around 24, but he's wondering if 26 is still a reasonable price to top up.
Yeah, so now it comes to investment advice, right? Which we can't do, Richard. But let's say like that. I think let's say like I do think that the current current oil price has not been priced in enough in the Shell share price.
Yeah. For me, I personally think 26 is reasonable. For me, that would be a buying price for me in terms of Shell. But they always seem to get to 30 and just stay there and come back down.
Remember, this is not investment advice. This is your opinion for entertainment and fun.
Yeah. For me, that's for me. Exactly. Yovel has said, would like your view on whether HPQ can successfully execute its turnaround?
Yeah, so I don't see it as a turnaround, really. I just see it as a business. This is what you get. And they're betting on AI machines, powerful AI machines. What I see is happening just really quickly is that there are many layoffs in the corporate world, so the renewal cycle is being delayed. There's still a lot of things in the pool, and also they are hit by cost inflation. I mean, I want to buy a PC for my son, and DDR-RAM, the same one I bought like 2 years ago for €100, is now €300. So, and they kind of pass on everything because it's quite competitive with all the Chinese stuff that is also offering laptops and everything. So that's it. And then tariffs on top of it, but it's not the biggest one. So it's not about the turnaround. There are some macro events happening there that are impacting their cost model and delaying some buys. So I don't see it as a turnaround. I think management is executing well.
A lot of heat in that company. But World Investor has asked, if you wanted to top up your allocation to industrials, what would be some good candidates? Many of the usual suspects, Siemens, Linde, Snap-on, are so expensive.
For industrial right now, I couldn't give you a proper answer there. I know they sound more expensive, so I'm on the fence at the moment in terms of industrials.
Yeah. I don't know in terms of valuation, but some industrials I like are Honeywell, John Deere, including some of the ones that you mentioned there.
Yeah. But now it doesn't feel like this time where industrials are an attractive sector. Yeah.
No, as World Investors said, they to me they still feel also expensive at the moment. So I agree.
Good. So there was somewhat of a lightning round, Derek. It went fast. We did it in 4 or 5 minutes. So that's a record for us. Thank you, everyone in the community. I mean, we had a lot of questions today and mostly filled this show. I hope we served you with this, that you got some inspiration out of it. A lot is going on in the first week of the year. For podcast creators like us, it's really good because we have something to talk about. So thank you to everyone who's helping shaping the news for us and making decisions that are attractive to us as dividend investors or not attractive. That's also something to talk about. And we're going to see if we will have a live recording next week in Malmö. We'll do our best. I'll bring my equipment with me, Derek. Let's see if we find a spot to do it with some locals with us. And yeah, thank you so much for everyone. Have a great start of the year and see you next time. And see you next time on the inside again.